My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 30 minutes here on Options Guy TV. So the big day has happened. NVIDIA has done a 10-for-1 stock split. So if you woke up this morning, no, NVIDIA didn't drop 1,000 points overnight. It went through a 10-for-1 stock split. That means that if it was trading right around 1,200 on the close last week or somewhere close to that, it would be $120 stock. And at this point in time, we see it at 121.94. It's up a smidge today. I personally kind of was thinking that the split was going to be an opportunity for people to take some profits on that underlying stock. So if you were going to take profits, and I've owned NVIDIA for quite some time now, and I'm not selling it. But with that said, if I were to sell, I would strongly consider doing it right now. With all the hype and the parabolic chart that if you look at what's happened in NVIDIA over the last couple of months heading into this stock split, there's just a chance to try to maybe even sell and try to buy a little bit lower, do a little bit of a swing trade in NVIDIA. So going into this event, we actually looked at a couple of at the money long call spreads. Both of them panned out. Also last week, we looked at two trades in the NDX, in the NASDAQ 100 index. We did a skip strike butterfly starting, that was a 7-day trade. We did it on a Friday, went from Friday to Friday. That trade didn't really work out. Part of the rationale behind it was, well, maybe NVIDIA might sell off going in to this big announcement. But as far as jobs were concerned, we got a little bit of mixed data last week. We had the API numbers come out on jobs, kind of hinting that maybe the non-farm payrolls would be a little bit less good, which is good. But non-farm payroll numbers knocked it out of the park. Or you could just have a strong week. NVIDIA or NDX, the first trade hurt us, mainly, I think, because of the API number that came in on Wednesday. Just had a strong move overall. And then we doubled down. We went in and did another skip strike butterfly with only a few days remaining. And that wanted the market to stay below 19,200. And right now we got the index right around 19,000. So it definitely was below 19,200. And because of that, that trade worked out. Now, lost more on the first trade. If you manage your position, you would have done a little bit better on it. But the fact that we were only really looking at it when we're doing Options Guy TV, that trade hurt. The two long spreads in NVIDIA panned out. They both made the maximum. They were 10 points wide. We put them on for 550, made 450 on the trade. The second NDX trade worked out. So we did salvage a decent week in our, I guess, non-official portfolio of weekly trades that we put on. Now, on Wednesday, I'm going to come back and look at NVIDIA and look what happened to our paper trading portfolio of deep in the money calls that we've been running since October of last year. That's the first time we put in a position on NVIDIA in the middle of October of 2023. So we'll look at that position, see how the strikes got adjusted, and actually address that trade. Might actually sell a call in NVIDIA. We haven't done that in a while. We almost got pegged or taken away on one of our call positions that we did around our deep in the money substitute for the stock. And that's really what that paper trading portfolio is. We'll go back and we'll look at that and we'll see how that adjusted our trade. But to start with, let's run to the TradeHawk software. And I want to talk a lot about the sadness that NVIDIA did the 10-for-1 stock split. I know if you want to buy shares of stock, it's going to be easier to buy a nice round number. And I do think that is a good thing. And I agree with that, even though, if you take a pencil and you break it in half, all you have are two pencils. It really does nothing to the underlying stock. But it does allow people to buy a nice round 100 shares, which also helps when you're looking at selling call options against it. I really don't believe in fractional shares. I think that concept, is kind of, well, it's opened up some opportunities. People like to buy 100 shares. You think about the options trading world, I have to have 100 shares to be able to sell a covered call against it. So in general, that's a good thing for those people that want to buy 100 shares of stock and sell covered calls. Now, if we're trading options though, so for example, I'm going to grab one of the long call spreads that we did last week. Uh, this was the one we put on Wednesday, and it expired on Friday. And when we looked at our trade on that day, Nvidia was at $1,132. So it was up from where it's at right now. And we bought the 1,115 strike call and sold the 1,125 strike call. Now, that's a 10-point wide spread. And that spread, if you divide it by 10, then the strike prices become 111.50 and 112.50. So now it's 1 point wide. And here's why I'm sad about that trade is I probably wouldn't do the 1 point wide spread. We sold an at the money option contract, and we went 10 points down and bought an in the money option contract. Now, when you're looking at those trades, we did it for $5.50, and we had $4.50 worth of upside. We were positive time premium, and that's the way that we set it up, in that if the market stayed where it was at or drifted a little bit higher, we were great. We were just fine. Time decay was our friend. We sold more time than we bought. Our break-even price was below where the stock price was at. There's many ways that you can say that, but we set that up on purpose. Now, we set it up that way. We wanted to be positive time decay, a lot of volatility in Nvidia last week to trade the high-priced options or the high-priced stock, however you want to say that. The both apply. And now, when you look at the trade, you're only 1 point wide. And here's where the pricing dynamics come in. So let's go in and we're going to look at the 121.50s. We're going to buy that. Let's just go with 4 days remaining. And we're going to look at selling the 122.50. So we're literally straddling the stock. Stock's almost right at 122. So we're only 50 cents wide. Now, here's where the dynamic changes in the pricing world. If you're sitting and you're looking at the 121.50s, right? That's very close to the 122.50s. And you say, well, that's obvious, Brian. Thanks for pointing that out. But when that is the case, if this option contract that you want to hold its value gets intrinsic value, right? This option contract is also going to hold its value because they're so close to one another. It's hard to get good time decay out of this option contract, even if you're correct on your forecast, 123 or 123.50. So even if you have that scenario, it's very hard to get the premium to come out of your sold option contract in this scenario. That's only 1 point away from the option contract that you bought. If you're 10 points wide, well, now you got a little bit of fluff, right? We're deeper in the money and the market goes up. You have that intrinsic value dominating because it's 10 points of intrinsic value now on the option contract that we bought. And your other option contract that you sold, the juice can slowly decay, can decay at a faster rate than the deep in the money in the option contract that has a lot of intrinsic value. So if I'm looking at spreads, obviously the wider you go, the more risk that you usually have because you have more upside. If you're just talking about a long call spread or even something like a skip strike butterfly, if you can get wide, you can get further away on the option contract that you bought versus the one that you sold, let's say the option contract gets in the money on the one that you bought, right? Well, then the one that you sold is still further out of the money, and time decay is hurting that option contract. And that's what you want. The wider the width, the better overall for people that are correct on their forecasts when they're doing butterflies, skip strike butterflies, long call spreads. But it does add a layer of risk because you have more upside, you're going to have more risk. So when you do a 10-for-1 stock split, no longer is that 10-point wide long call spread as attractive because now it's only 1 point wide. I don't know how else to say it, but I'd much rather trade $1,000 stock than $100 stock when we're doing these advanced strategies because of that dynamic that goes along with option pricing. So I'm not going to put on a trade in NVIDIA. Right now, it was down on the open, not much, a few dollars, and now it's up $1. At this point in time, up about 0.75%. Let's call it that way. Let's just do it that way. And if I were to do a trade, I think I would be bearish and I would do a longer term bearish. I would go maybe out to June and either do a put spread or maybe even just buy a put. The implied balls are still fairly high, and I would be a swing trade. Long term bullish on NVIDIA. Think that this move is a good thing for the company. Still worried about the fact that if you go and look at the chart, and let me pull up the chart here. It's parabolic from this move right down here. Right when we had these two little touches, then you got this huge gap all the way up. Some people might make the argument that the gap needs to fill, and it could come back down to this range and trade down, down around that 100 range, which is a 20% drop. Not calling for that. I'm not saying that, but I'm more nervous about where it goes from here in the short term. Long term, still bullish. Still got your ducks in a row here. You got your 200-day moving average, and above that is the 50-day moving average, and above that is the 20-day moving average. But we're getting so far from the 200-day moving average, it just makes you nervous, and this is an opportunity to sell off. Market was down a little bit today. It's up. Enough said about NVIDIA. All right. So this week, and I think we're going to let's jump out here for a second. And by the way, if you have any questions, please do put them in the chat box. If you're in the Tradier YouTube platform, you have to be in the Tradier YouTube platform. You can join in by just typing anything that you'd like to talk about in the chat. I'm now going to look at a trade. We're going to look at our weekly paper trade that we can do. And like I said, on Wednesday, we're going to come back and look at our paper trading portfolio and talk a little bit about what happened to the NVIDIA way deep in the money option contracts that we had. So in this scenario here, I'm going to pull up, the topics this week. We have the Fed decision on Wednesday after the CPI print. So I'm actually going to look at doing a VIX trade. We haven't done many VIX trades, and I think that the opportunity is there. I think we could expect a little bit of a rise in implied volatility, and I'm going to do a 50-50 bet in the VIX. And I like this risk reward on this trade. I like where the VIX is at. I do anticipate that over the next couple of days, it's going to be a little higher going into that CPI print. So here we go. 1 second. Let me grab the actual FedWatch tool. So let's start by the June 12th meeting. Okay, so let's show it. And here, if I look at it, here's the FedWatch tool that's put out by the CME group. This shows you how many days and minutes and seconds until the next FedWatch meeting, or to the next Fed FOMC. Let's just say it this way, FOMC meeting. That's much easier to just say. So that's the countdown. And this is the June 12th date, and hardly any probability at all that there would be a rate cut, right? They're basically saying 100% chance that things are going to stay the same. Here's the current rate, 5.25 by 5.5. Right here, this is where it's saying 100% or 99.4% probability. So when is the next potential cut? Let's look at July. We click on July. Notice there's not much difference between June and July. So still anticipating that throughout the summer, right now, based off of where the futures are trading, the marketplace is saying that there's probably not going to be a cut in July. But we get to September, and all of a sudden there's a 50-50 chance. So this is the current rate. Excuse me. And this is a 46% chance of them doing a 25 basis point cut. And they're actually saying a 4% chance that they'll do a 50 basis point cut. I don't think that that's even feasible. But so you're looking at a little bit higher probability around, if you add these two numbers, you're saying 50 to 49 that they will actually cut 100% a coin flip in September at this point in time. Big CPI numbers are going to be obviously very big. The Fed's is really watching them, and they're announcing right before their meeting on Wednesday. So let's get to the trade. Here's the options playbook. And by the way, we have new graphs in the options playbook that actually show the movement over time of what a long call spread looks like. This is actually going to be a short put spread, and that's what we're going to do in the VIX index today. But so it's showing from 24 days out, and it will show how the graph moves as we approach expiration. And the pink line, I guess, for lack of a better word, shows you how the profit and loss break even happens as the expiration approaches. You can always go in and just pause it if you want it to just stay right where it's at. But these are the new graphs that we just recently added, and it gives you a little bit of detail on the graphs, tells you what is expected or what is actually happening on the graph, 24 days to expiration all the way down to 0 days. And there you go. So here's the setup. We're going to sell a put at strike A. We're going to buy a put down below the market. We're going to sell a put at the market, basically where the market is at. And generally the stock will be above that put that we sell. So let's run back out and let's look at the trade. Here we go. We're going to jump back into the TradeHawk software. And this will be the official paper trade. Once again, if you have any questions, please feel free to put them in the chat box and I will try to address them. And here we go. Right now, we see the VIX index, which, remember, the option contracts don't trade based off of the spot index. They trade based off of the futures contract. But as expiration approaches, the futures contract is no longer in the future, right? So it's going to go towards the value of the index, or otherwise known as the spot. So if you really want to trade the movement of the VIX, the actual index, the only way to really do that is to use very near-term option contracts. So the VIX expires on Wednesday, and it doesn't really have any Friday expirations, and it has a lot to do with the calculation of the VIX. So it's usually every 30 days. But the big deal is that it stops trading on Tuesday, and they do an opening rotation, a special opening rotation. I'm trying to think of the terminology of the CBOE uses, but they do determination to try to come up where the value or the settlement price of the VIX is. But the last day to trade out of the options is on Tuesday. All right, so we're not going to risk a ton. I never want to do that in the VIX. The VIX is a very speculative index. We got the market at 1295. That's currently where the VIX is trading. Slide that down right here. Up a little bit today, even though the markets are kind of, well, actually the market is down a smidge, but I would call it flat in the SPX in particular. We still see the VIX up about 72 cents. And I think that has everything to do with the volatility that this Fed meeting can create, and the CPI number. So I anticipate that to go up, especially throughout the day and throughout the day tomorrow. I'm hoping to close this trade at the end of the day on Tuesday, or else we got to wait around and we take the risk of the settlement on Wednesday morning. And there's no rhyme or reason as to where the VIX settles at. It's really hard to get a grasp on it, but they print a number, and it's actually under the symbol VRO, and that's the settlement value. And they're cash settled. So cash either goes into your account based off of where the VRO is relative to your strike price, or cash goes out of your account. And it's that simple, that straightforward. So you do have overnight risk if you choose to stay into the VIX on the Tuesday going into the Wednesday expiration. But I don't mind the numbers where they're at right now. If I look at the 13 strike put in the VIX index, I'm seeing that that's trading for 40 cents. The VVIX, which is the volatility of the VIX index, these are the volatility of the option contracts inside the VIX index, the VIX of the VIX, a lot of people like to say, is trading around 80% right now. Now, that number can skyrocket. It's easy for that to fluctuate all the way up to 180%, or 100, 150, 160%, and then come, down at low end of the range is probably around 70%. So it's at a normal implied volatility right now. The VIX is fairly low. To me, it's around 13%. I think that's a little bit low, especially considering the news that we have coming out this week. So 30 cents by 40 cents. I don't mind just selling this put. I literally don't mind it. Your risk is from 13 on down. VIX does not go to zero. So 10, you would almost have a free put from 30 down to 10, right? You have, because the VIX index very rarely on a couple of days notice goes below 10. Now it could skyrocket up to 80 or 90. That on the upside, you have unlimited risk on the upside. On the downside, there's got to be some volatility premium in the 30-day option contract. So you kind of have this free put as protection right around that 10 level. So I don't have any problems. And in my own account, $3 of risk isn't that big of a deal to me. So I wouldn't mind just selling this for 30 or 40 cents, just selling it outright. But if you go down to the 12.50 and even the 12, the options are so cheap. So why not buy one, right? Why not protect yourself? And for the sake of the show, I always want to go with a little less risk than a little more. So I'm actually going to sell the 13 and buy the 12.50. And if you do that, if you come in and you sell, let's get rid of our NVIDIA example that we were looking at, and we sell this 13 strike call, and I'm sorry, not call. What am I talking about? I just said that. If we sell this 13 strike put and then buy the 12.50 strike put, that's our short put spread. And it's a 50-50 bet. You're paying, if you go mid to mid, that's where we're kind of at. And these option contracts are liquid. I would expect that we could fill somewhere close to this. And my goal would be to pay 25 for it. It's now at a 27-cent net credit. Shouldn't say pay, bring in 25 cents for it. And you have a 50-cent wide spread. Excuse me. You have a 50-cent wide spread, and you're receiving 25 cents for it. So do you make 25 cents or do you lose 25 cents? I'm hoping that the market moves up over the next couple of days and I can close this out for maybe 5 cents and take on that 20-cent 20-cent credit before the CPI number comes out on Wednesday. That would be my ideal scenario. See the VIX start creeping up towards 14. Going to have a huge rate of time decay. The fact that this 13 strike option contract is still trading for 40 cents. That's kind of crazy. And if you wanted to, you're willing to take on a full point of risk, you can buy this option contract for 3 cents or somewhere in the middle there. And like I said, I don't even mind selling this just naked because you have a free put basically down around 10. Very hard for the VIX to breach 10. And you can even look at the chart and pull that up right now and VIX. And you just see that there's really, you'd have to go back years before you're going to see that VIX below that 10 level. Other little thing on the VIX that I don't mind is it's a mean reverting average, right? So I pay a lot of attention to the 200-day average, even the 20 and 30. I wouldn't mind even putting up a 30-day average because the VIX is a 30-day weighted index. But here's my point. We're hanging right around the 20-day moving average right now. The VIX is mean reverting. It likes to be pulled back to the 200-day moving average. It just really likes to do that. We have an 800-day chart and here that's a couple years out, but that's just for data purposes. So we hang around this 50-day a little bit, get a little bit of a move up. Right now, we're a little bit divergent on that. We're down in this level, and we came down all the way to here, made that ride back up all the way right to the 200-day and then pulled back off again. So there's room for movement in this range. And that, I guess, was my only moral to the story here is that I don't mind. There's news potential that can blow this up a little bit. The moving average is okay, saying I want to get back to that 200-day moving average. I got the room to do it. I like this trade. That's straightforward. Very short-term trade, obviously a lot of risk. And that's going to be our paper trade for this week. So let me go back, put up the trading page. And I'll say to you, and there we go, 25 cent is going to be our midpoint. I'm going to work that for 25 cents. I'm going to give it 27 cents is the mid here. I think you could feel that, but we'll leave that. And yeah, let's come back out. If you want to take your screenshot, there's your chance. And then thank you for coming, everyone. We'll be here on Wednesday for the next edition of Options Guy TV. We'll know what has happened with the VIX options. We'll probably even get the settlement value by then. Sometimes it takes a few hours to get it, but we kick off the show at 11. I would hope that the VRO or the VIX settlement price will be out. My goal would be to close this before the close on Tuesday. That's if you don't want the risk of trying to determine that settlement after the CPI. The Fed meeting is not until 2 o'clock, but the CPI number will be out. So that is probably the most risky of the two events. So ideally, we close this out on Tuesday if we can. But then again, riding it to Wednesday is worth doing, and we will evaluate if it was worth. Well, is not. I shouldn't say worth doing. Is an okay way to trade this. If you do get a bad CPI number, markets would obviously react and implied volatility would go up. So thanks for coming. Excited about the VIX trade this week. And on Wednesday, we'll look into our NVIDIA position inside our Trade Hawk paper trade portfolio. Thanks for coming, everyone. Please follow me on Twitter. We stream these shows, All Options Guy TV, live on Twitter, so you'll always get the alerts. My handle is @BrianOverby. And also check out the Tradier Hub. The Tradier Hub is where we put all the speakers that are associated with Tradier and give you a plethora of information around trading in general, all the way from volatility trading to bot trading to just everything. So please check out the Tradier Hub. Thanks for coming by, and see you this Wednesday.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.